Hello and welcome to LiveSquawk's Market Talk, our weekly review this Friday, the 12th of December, 2025. This is where we break down the key stories of the week gone and the implications for the markets. We'll also take a look at the week ahead and try and give you a heads up as to what you should be looking out for. This episode, I'm joined by regular contributors and long-time traders, and both two people from Switzerland. Beat Nussbaumer, founder and CEO of MacroBeat. He's an FX macro trader, researcher, and FX tutor, and market professional for nearly 40 years. And we're joined by Gunter Grimm, strategist and trader, 25 plus years in FX, fixed income, macro, and quant, and owner of GGMA, a platform for traders. Before we introduce the two guests, the content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And again, we're just about 2 weeks out now from Christmas break, so everything's starting to wind down, and we're starting to really just get congestion in terms of data and central bank events, really, as we come to the end of the year. In this week's edition, we're looking at the week gone, FOMC, UK GDP, the Swiss National Bank rate decision, amongst some other things. I'd like to welcome my two guests then. Beat, how are you doing, my man?
Hi, Harry. Very good. Thanks very much, and thanks for having me.
Always a pleasure.
As usual, a real pleasure to be talking about all that we tried to get through today.
It's a passion, so it's
yes.
You know,
it's not a job.
And Gunter, how are you?
Yes, thank you. Thanks also for having me. I'm very well, thank you.
This is an episode first. I've got two fellow countrymen on the same podcast, so it's first for me. Both proud Swiss, both live in. Well, actually, no. Beat, you live over here, and Gunter, you're still in Switzerland, but you're familiar with the UK and London. Right. So let's get into it then. The week that was, and obviously it's headlined by the FOMC, and my question is the Fed now finished cutting? We'll start with you.
Yeah, to be honest, I think to me it got very sort of clear whether, from all the Fed speak in the run up from all the other noises that we had out there, that probably Powell had to convince the rest of the board that we sort of cut in December. It was price, we knew it's going to come. But if he sort of looks through all the noise, it really seems as if, even though the market didn't really go that way just yet, that we might just have a pause, and maybe we're going to have a very long pause. That probably depends more on what we briefly mentioned in the intro before we went live, that maybe the non-farm payrolls on Tuesday might actually be more important than the Federal Reserve, because a very weak number would suddenly bring the pricing in more cuts for next year. We get probably a dovish Fed chair, which we already know. Whether that really, I think that's the only part why we sort of remain dovish on the night and a little bit more dollar weakness on Thursday. But since sort of late yesterday, I think the sentiment out there started to change. Look at 10-year just back to nearly 420. So you just can't keep yields down right now. So I think the nerves out there is just we might get a bigger pause than the market did expect. So I personally think like we might not see cuts anytime soon, and that maybe there is a small hawk in there despite all this dovish talk from the usual suspects like Bess and Trump and the potential incoming Fed chair.
Well, it was just interesting that the reaction, what reaction that you said there was, really. We did see equity markets now, the risk assets, just find a little bit of upside in the immediate aftermath, really, of the event and while Powell was speaking. But yeah, I mean, everyone had pegged this as a hawkish cut, really, and it didn't disappoint on that front. But maybe some viewed it as slightly less hawkish, obviously, of quantitative bond purchases or whatever.
Like we say, to be honest, I think because the market is so well priced to the last letter of the word, that I think the market was actually a touch worried that it's be a fraction more hawkish. So I think the reaction we've seen is not that it was dovish. It was maybe just not as hawkish on the headlines as some did expect, because it did stress the weakness in job data. And so he did leave a few bits and bobs in there that can be seen a bit dovish. Then it's the usual, which we had before, the QE, which isn't QE. So that probably helped a little bit. But when I look out there right now, I don't see any. That seems to have gone away rather quickly.
Yeah, fair enough. Gunther, what are your initial views on what we saw on Wednesday?
Well, my initial view was that Powell did sound like he wanted to keep his job, i.e., I really think he was very, very dovish. Sorry, I have to disagree a bit, but so he made a few observations. So first of all, they're still very confident that inflation will come down. He cited a measure like X tariffs, which is already close to 2%, although we don't know how he calculates it. Then he was very downbeat on these labor market numbers, saying that he would subtract 60,000, I think it was, he mentioned, from the official headlines, and that's the true number. Again, we don't know how the Fed calculates it. And then, this QE, I call it QE, although they're buying T-bills, but it will have a ripple effect through the system via the yield curve and other assets. And basically, they're financing the government budget deficits. And Beat mentioned it, the yield curve is steeper, yields are higher, and that's exactly reflected in the yield curve. I said to my clients ahead of the meeting, if they are too dovish, then you will see the yield curve steepening. Let's say 10s, 2s, they were at 56 basis points before the meeting. They're now above 60 basis points as a benchmark. And I think this trend will continue. The dollar was weaker. And so on and so forth. So yeah, I really found them very, very dovish.
Okay, interesting stuff. We'll come back to the Fed because obviously we'll take a look at the week ahead in a bit. I want to just turn to today's, as we're recording this on a Friday. We got UK GDP out today, and another disappointing print, negative 0.1% for both the month-over-month and on the 3-month rate. The 3 months up until October. We were looking, I was predicting it in one of my last podcasts that we might see a bit of a bounce back following the reopening of the Jaguar Land Rover factory in Coventry. After that was mothballed for a while due to the cyber attack. It didn't come back. It's not bounced back as hard as we thought. Production wasn't ramped up to the levels pre the cyber attack, it would seem, or at least we're not seeing the effects of that yet in these numbers. Rachel Reeves, the UK Chancellor, has been saying non-stop that she wants to bring growth. She thinks growth's the only way we can really get ourselves out of the trouble that we're in. And yet, since they've been in power over a year now, it's been tepid, and if not, as we've seen recently, on the negative side. Beat, I know you're not particularly upbeat about the UK economy, about the UK at the moment, but do you see any hope in the near term? Where's the growth that Rachel promised?
Yeah, I just had to laugh when you started to shift towards me, because everyone who follows me on X will probably have no doubt about my view about the Chancellor and the current government. No, kidding aside, we know she made a real mess about the budget in a run up to it. I think the market, or the businesses as well as consumers, run scared already for multiple weeks, if not months. So that has already had its impact, even away from actually the true. Some of the tax hikes haven't even been seen yet; they're only yet to come. Truth be told, I just feel the same as I have done for a while. You can't tax yourself to grow. I think the budget is terrible. Maybe the best thing she has done, if you want to give her some credit somewhere, if she has lied herself, or let's not call it lied, she has maneuvered herself to a little bit more fiscal headroom, which at least kept the gilt market a little bit on side. But I think the gilt market may have given them the benefit of the doubt. But if these numbers remain as they are, which may well be happening because some people only get hit as of sort of March or April. Businesses might only start to get hit from all the other stuff they introduced, from is the contract side, the minimum wages, blah 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 blah, the whole sort of thing. I don't want to drag on too much about we're taxing the producers and give it to the non-producers, but on balance, that is something that is happening in the UK economy. The budget was one for her to keep the job, had nothing to do with the growth budget. It isn't a growth budget, and I honestly fear, and this is not just because I don't like what they're doing. I really honestly fear since quite a while that we're starting to damage the UK economy to the point where this is just only really this sort of doom loop that people talk about. I just can't see it. I hope I'm wrong because I live in the UK and it doesn't give me pleasure to say all these things. But I've been core short sterling in 2025, mostly versus euro, because that's the easy way to carry it, because I was also a dollar bear, so you couldn't really play cable. And to be honest, I see no reason whatsoever not to be short sterling going into 2026, because truth be told, there's just, in my opinion, the lights at the end of the tunnel is just a freight train. That's still what I honestly believe. And until that sort of changes, that I actually start to see green shoots. Every time we see green shoots, rates will come for more. And so I just can't see it get any better. Sorry. So I really don't.
Gunther, cheer us up. Do you only see green shoots or anything in what from the UK data? Not so much this month, this October data, but generally for the UK momentum. Do you see any light at the end of the tunnel?
Well, I guess Beard is quite right. The policies they're enacting are not pro-growth, rather the contrary. But I watch sterling Swiss just out of interest and sometimes trade it a bit. And that has weakened ahead of the budget announcement, and now has a bit rebounded. So has cable, but maybe the dollar weakness story is also part of that. But so we're not making new lows in sterling Swiss. So one also has to look at positioning a bit to see if it's still worth shorting sterling at these levels. So personally, technically actually a bit long, a bit underwater, but there's a bit of carry and looking for a bit higher sterling Swiss.
Okay. Just the National Institute of Economic and Social Research, the NISR, in their main points about today's GDP, they said survey data indicates ongoing weakness in November, with businesses reporting that pre-budget uncertainty resulted in delayed investment and weakened consumer sentiment. The upshot is that conditions could improve in December now that the budget has passed. They also go on to say, following the poor start to the quarter, we expect GDP to show no growth in the fourth quarter, underpinned by stagnation in services and falling GDP in production, construction, and agriculture. So not much in the way of good news from there. I mean, we did see a downgrade of 2026 GDP by about 0.5%. We are looking to see that pick up again by the same increment for 2026. But then, as you say, it's been backloaded. In fact, the budget for the UK economy. I'm sure we'll revisit this one because there's a lot more to talk about the UK economy. I'd like to bring someone on who may have some positives, but of all my guests, I'm not just about you guys. Very few people have at the moment, which is a sad indictment, really. Right, moving on then. You guys might know a little thing or two about this. The S&B left rates on hold at zero on, when was it, Thursday? Yesterday, was it? And where do you see the Swiss National Bank at the moment? And is this another one of those they're in wait and see mode? There's no impetus for them to sort of go after anything now. They've got the trade agreement with the US sorted for the time being. I will start this time with you, Gunther. What are your views on the Swiss economy and the
sure.
S&B?
I mean, just minor observations. Heading into the meeting, I think Schlegel said that he expects inflation to rise a bit in the short term, not massively, but to rise. And now they revised their short-term inflation forecast a touch lower. So that's slightly on the dovish side. They reiterated they're willing to intervene, which for me is really surprising, given that Trump is ruling and they have this currency manipulator list. So it's very self-confident, but I take them by the word. So if worse comes to worse, they would intervene, but would really need a sharp move lower, or lower in Euro Swiss, for example, or sharp move lower in dollar Swiss, for them to intervene or to go negative. I think at the moment they're quite happy as things are, and I kind of agree with the market that they're probably on hold. But they will be on hold longer than the ECB, for example, to keep the interest rate spread between Europe where it is probably. If the ECB were to cut rates, but I don't think it's likely at the moment, then they would probably go negative. But so far, so good, I think, from their point of view.
Okay, fair enough. And Beat?
Yeah, obviously that one is close to my heart. Yeah, to be honest, I think the new regime under Schlegel, when Jordan left, I knew Jordan actually personally. I think there's a bit of new guard in there. I think the Schlegel started off a little bit on the wrong foot. Personally, I think some of his communication was a bit too much for that he should have said to the market. I think it's no secret how much the current team on the S&P hates negative rates. Of course, they then change the wording a little bit. So they now, of course, on the old mantra of, if need be, they would do it. But I think the bar for negative rates is a lot higher than it was. I think it's now just reserved for either external shock, or if we would indeed get a negative CPI, that would be on a prolonged period. The S&P already signaled they tolerate a negative CPI in the short term. Let's not forget they have a 0 to 2% range, so they can be quite flexible on that. Re-interventions, the S&P has been involved just a few weeks ago, down when Euro Swiss was below 92. They're not buying Euro Swiss, they usually buy dollar Swiss in whatever. They just do this in a sort of reserve kind of managing way. And I think because they obviously, some of the dollars they buy find its way into the US equity market or the US bond market, I think the Swiss have managed to sort of explain to the US that they're not ramping, they're not weakening the Swiss. It's more like a liquidity management operation. So I think this red line in the sand, 91.5, 92 in Euro Swiss, has held very well and has held again a few weeks ago. So I think that story is going on, but it's a very passive management. And I agree, it's going to the last thing they want to be is too obvious when it comes to the US. But I think this is kind of like has been going on for actually quite a while, that they've been in a sort of passive kind of way. So personally, I think we've seen this Swiss weakening in the last few weeks. Günther mentioned sterling Swiss, we had Aussie Swiss, we had Euro Swiss. So for me, given the time of year, it's actually been more of a profit-taking wave of long Swiss positions this year. And I think I just want to quickly break into another kind of correlation, which has been seen a little bit this year. This whole fiscal worry abroad, this sell America, that sell this, sell that, the pressure in the bond market out there, the debt situation, the fiscal talks. The Swiss franc at some point has been seen almost like another gold trade. And I think a theme we may revisit at some point. I'm picking up noises for, people want to buy Swedish krona for next year. So suddenly we start to get the focus on currencies that run actually quite low debt or low debt to GDP ratios, which is maybe a newer story in town, maybe a bit earlier right now. But, Euro Swiss came off as fast as it went up once his profit-taking wave was over. And I'm a traditional kind of, I feel the Swiss franc is so overvalued that it's nearly stupid. But the reality is the gravity is still for Euro Swiss to go lower. It seems the current account surplus is just, if nobody trades the Swiss, Euro Swiss has a natural drag down. And I think with everything which we may cover later on the geopolitical side, some of the other problems out there, I just can't see the Swiss franc really weakening anytime soon. And I think the S&P can do whatever they want, as they have done. It won't make a difference.
Okay, fair enough.
Maybe one more observation. I agree with Beat and the current account, but regarding that, I'm watching the trade balance, the surplus we have still here, 4 billion or so per month, very closely, and to see if the tariffs will have any impact. Also, the chemical industry promised Trump a lot of investments in the US, so let's see how that then affects here the job growth in Switzerland even, or maybe they have to cut jobs. And on that note, I think the labor market here in even here in Switzerland is softening, especially in the banking sector, as we know, and also anecdotally in other sectors. So I think the unemployment rate will slowly but steadily also rise here.
Good points well made, guys. Thank you. We mentioned Europe. Trump's dumping of Europe this week. It has ruffled a few feathers, really, on a number of fronts, really. Just briefly on this one, Beat, what do you factor in, again, Trump's words when he talks about Europe and Europe standing on the global stage, and anything like that at all? Does any of that, and this goes into the question about Ukraine as well, factoring into trading strategies, and the two are intertwined. How much are you paying attention to the geopolitical situation at the moment with Europe specifically?
Yeah, to be honest, there's two things. Let me say first something on this Ukraine situation. I mean, factoring as a trading strategy, we haven't really traded the Ukraine war in recent times. We may have the odd brief intraday risk rally or sell-off on some of the promises of peace or non-peace, but broadly, I don't think we really traded it. But I think what is worrying, and I find it extraordinary, again, just before watching the UK news, when they talk about preparing for war, and the NATO rooted yesterday about, we have to get probably ready as our grandparents see. It's extraordinary, I feel, what gets talked about real war, and we just digest it as if we have some new breakfast cereals. So that is the worrying part I have a little bit, where I'm not quite sure where we are right now. It seems nobody's bothered, but it's something maybe we should be bothered, because I think the way Trump is throwing Europe under the bus, and I think I have sort of two views on that. Europe didn't do what they should have done for probably years, so a little bit of waking Europe up is maybe not a wrong thing. On the other hand, I think it's extraordinary what Trump is doing in regard to the story from yesterday about trying to create four nations in Europe that would sort of break with Europe, even though he's a bit not so educated, good old Trump, when he talked about Italy and Austria. I think we learned it in the Greek crisis that people that are in the euro is not so easy to leave. Maybe something else for Poland, completely something else for Hungary, which we know the Hungarian problem. So I'm not sure where this is all lead to. What I don't like is the way we talk about war as if it be like, something so natural to talk about. It hasn't come into the market. I think it has to be looked at if we prepare for 2026, not just that one, but maybe it's something we may talk at a later stage when we talk about Taiwan and so on and so forth. Maybe another reason to have a bit of a core short Euro Swiss just in case, but it worries me. While Trump talks a lot and we discount half what he says, but the trends we are seeing all of 2025, the break with traditions, the break with alliances, the break with suddenly the dollar just being, or money just being, the only driver of diplomacy is something very worrying. It worries me a lot. Not that I already connected to a trade, or I would tell you, oh, I do this or do that out of it. This is more on a personal level, which is something I think we have to look at, because we are traders, we are risk managers, and we have to sort of prepare for some of these black swan events should they happen. So the likelihood is higher than it ever was, probably. That's probably
the risk is underweight. Is underweight. We're underweight the risks around.
Yes, that would probably sum it up. Yes.
Yeah. Okay. Gunther, do you have anything to add on that?
Yeah, I couldn't agree more with Beat. I'm also surprised that the markets shrug it off as they do, probably saying they don't believe in war. So for me, it's make or break. I'm of the view that Trump really doesn't like the Germans and the French. So therefore, this other idea Beat just mentioned kind of makes sense to me. Therefore, it's really make or break for the Eurozone, especially for Germany in the next couple of years, up to the next general election, because the right-wing AfD party is leading in the polls, close to 30%, I believe. And if this government fails, and it looks like it, unfortunately, in the polls, they're not doing well, then all bets are off. And so they really have to do something. It's, of course, also a bit binary. I'm more skeptical regarding a potential peace deal with the Ukraine and Russia. I think they are too far apart. How do you want to square the circle? So for Europe, it means either convince the Ukrainians to give up the Donbas, as it looks like, or keep on fighting, but then without the US. And then we are also, I think, talking about boots on the ground in Ukraine from core countries in the Eurozone. I don't know how likely this is. So, but I think those are the decisions which need to be made in the future. So yeah, I keep a close eye on it, and yeah, it's a dangerous situation. On the other hand, should there be a peace deal, then I think it's very positive for the euro, because you see a lot of reconstruction going on. I would expect real yields to go up in Germany, especially, and in the Eurozone in general. And that should be then really good for Euro-Swiss.
Okay.
But how likely that is, I don't know.
All I will say is, when it comes to diplomacy, and the brinksmanship is one of the things that is prevalent in all this. So, taking it to the very edge and then pulling back, you've seen many a time, I think, in history. And it's just, in my opinion, it's one of those games on a geopolitical level people play in order to get what they want and what they think they can get in that respect. But yeah, I'm with you both there. It's never nice. It's not tangible, and we're a generation now apart from our grandparents that have been through this and seen it all before, and so yeah, I think we're a bit blinded by that as well. That we're a generation back, at least 2 generations back, I suggest, for understanding in reality what war means on a wide scale. But let's hope that we don't get there. Looking at the week ahead, then, and we'll start with the interest rate decisions. We've got the ECB rate decision on Thursday. Again, that last one of the year. Gunter, what are your views on the ECB? Or is it? I mean, we don't have to labour this, because I think you both mentioned it before, that ECB in Europe is on a fairly moribund course at the moment, where we're not likely to see any kind of movement out of the central bank. So, what is Lagarde going to communicate? What is it? What message can she send, Gunter?
I think they are on hold for now, but it's interesting to see that we had some hawkish comments, especially from Schnabel. She's a natural hawk, to be fair. She's from the Bundesbank.
I was going to say, surprise, surprise.
Exactly, you have to be a hawk as a German Bundesbanker. And then there was a story that she actually said she might be interested in Lagarde's job. So that would be something like a small hawkish tilt for the ECB. A welcome one, I think. But yeah, clearly on hold. And then the Doves and the Hawks battle it out. Yeah, growth is maybe improving a bit. Inflation, yeah, going sideways. So yeah, on hold, I'd say.
But yeah.
Yeah, to be honest, I fully agree. I think it's one of these meetings where she will probably more celebrate Christmas than anything else. So I don't really think it's a big event. When it comes to succession, I wouldn't actually mind having Schnabel instead of Lagarde. This is maybe less a vote for Schnabel, not that I have something against her. It's probably more a vote against Lagarde. But to be honest, we had an Italian head with Draghi when we needed it, and probably he was a big factor that Europe is still the way it is. And maybe it comes a period now where we need a little bit of the hope that the German side back in the ECB, because I think the next few years might be a lot about credibility, and I think maybe we just need a little bit that side. But as a meeting next week, I think it's more or less a non-event. There's no point for her to lean too much one way or another, because you don't need to rock the boat. I think we know they're on a pause. It's probably a longer pause, and the odd hawk will make exactly the comment Schnabel did, and that's okay. So the other people speak about disinflation, and so we're going to be here for a while, and I don't think it's a story at all.
what I would kick back, I think Germany, especially in the Bundesbank, have had an outsized influence on policy ever since I've been covering the ECB in any way, shape, or form since the early days, I guess. So, you know, even the Trichet days, he leant more towards the Germans, if my memory serves you right, or the Bundesbank's way of thinking than not. I know that you mentioned the Draghi years, but again, there were exceptional circumstances at the time for that as well. But I do generally think there's been an outsized appreciation of what the Bundesbank has to say when it comes to policy. Would you disagree with that then, you guys? Would you disagree with that then, that they've had a diminished, you know?
Yeah, to be honest, the German case is an interesting one, and don't want to jump on Günther. But you know, like we see. I'll just make a very simple example. You know, we used to be all over ZEW and IFO, and these days no one cares. Why? Because Germany is not top number one. It's sort of bottom on the European queue, which is quite surprising, or maybe not. So I think Günther sort of mentioned some elements earlier on the political side. I think Germany is in a very sort of precarious kind of place, and it's almost like a make or break for Germany, and indirectly can argue for Europe. But funny enough, in the same time, we had some of the Eastern Europeans, especially Poland, starting to sort of fill in. We have like Spain that's been doing a bit better. So the whole mix got a bit different. But in terms of policy, I'm unsure about the influence or not influence from Germany, to be honest. I didn't actually think too much about it as well. I'll be very honest with you. It's not something that did strike me to think about, because we had so many, as you pointed out. We had the Draghi years with the Greek crisis. We had the recent few years post-COVID. So there was so much other stuff going on that we always had an excuse for leaning either way of the framework. So I don't have a very strong feeling about this right now, to be honest.
We did hear from Lagarde this week, who talked about potentially upgrading growth looking forward. So, you know, she seems to be a bit more upbeat on the outlook for the Eurozone economy as a whole. She said, was it that she expected the ECB is likely to upgrade its growth forecast in the upcoming December policy projection exercise? And she noted that earlier concerns, trade tensions, external headwinds have not materially derailed activity, and solid domestic demand and employment data support a healthier outlook. Günther, I know, as I said, nothing's expected from next week's meeting, but did you see anything in the messaging that she may give to, give something to hang our hats on in terms of being able to trade around it?
Well, it's notable that the stir curve now prices in, I think, a small chance of a rate hike, and maybe the ECB is not unhappy about that. So, and this growth upgrade forecast goes into that direction. So I don't think the ECB will protest against that. And also, I don't think the euro is a problem. So euro going higher, that it derails growth or so for now, unless it goes too fast, too high. But at the moment, I think they're quite happy. It's a sign of confidence that the euro goes up for them, I think.
Yeah, okay.
That's how they see it.
Good stuff. Right, let's move on to the US again, and we're looking at US non-farm payrolls for October, November due out next week. Again, I wouldn't say stale data, and we need it. We need to understand where the UK labour market is at the moment, amongst other bits and pieces of data. So, how will you front up next week's NFP, Günther? What are you looking for, or what would you see as something that's worth jumping on as a trade, or are you? And I'll go into the psyche of winding down towards year end and how you look after your book going into the end of the year. But just on NFPs, are they an event for you next week?
I would suggest to take the day off. No, joking aside, I mean, how can you trust these numbers? They will probably not be complete. They're noisy anyway. If I could say anything, I guess the market heading into these numbers is probably more on the bearish side. So the market is probably expecting weaker numbers, looking at the ADP, which I think is a terrible indicator. I can't even believe that we are now watching ADP knowing that it hasn't had any predictive power, hardly any predictive power for the NFP numbers, or looking at other indicators which people now talk about. So to be honest, it's more like Russian roulette. Also, if I were to know these numbers in advance, I couldn't even tell you what the market direction will be afterwards. Payrolls is always a terrible day. So I really can't tell you how I will trade them. I look at the numbers, look at the market direction, and then make up my mind in that very moment.
No, fair enough. Pete?
But I have to say one
Absolutely.
thing. There are tentative signs maybe that the job market, and I've put a few charts together, but I can briefly talk about them, is maybe stabilizing. So the JOLTS report, although not the best of all labor market indicators, but at least something popped up a bit, which was a surprise, although the quits rate went down. That's something which is interesting for the inflation outlook short term. That means lower wages, probably lower service inflation. But if now the job market were to turn more towards a positive outcome, that would be the big surprise, given that the central bank talks about weakness in the labor market and so on and so forth. So I'm trying to play a bit devil's advocate there. So I would look out for signs that maybe the labor market is stabilizing or even accelerating. I mean, people talk about a growth rebound in Q1 next year, given the tax, the beautiful bill, and probably lagged interest rate cuts also play a role. And the stock market is close to all-time highs. It's also a decent leading indicator for growth. You have earnings growth, which is very strong, and there's a huge gap between earnings growth and these JOLTS job openings. And the question is, who's right? Is the job market right, and these earnings will come down because people are unemployed and won't buy anything anymore? Or will maybe CEOs feel more confident, hold on to labor, and then maybe rehire or hire more in a potential upswing we could see in Q1? So I would be very careful there. Here you show the jobless claims report. That was also interesting, although the headline popped higher. The continuing claims dropped quite a bit, and the latter is being cited by many market economists as a sign that if people get unemployed, then they stay out of work for longer. Now this number has fallen quite a bit, so maybe something is afoot here. I would also look at consumer confidence, especially present conditions. They correlate very nicely with labor market conditions at times, and that could be also something to watch out for.
Good stuff. Okay. Finally, then, flash PMIs. Then I know we look at the European ones. Do you, Beat? On NFP, do you have any? How would you trade around next week's jobs data?
Yeah, there have been elements I agree is going to, elements I do not. I definitely agree ADP is the joke what we do there, but it is what it is. I think the market is so clueless and so starved of data that they're just happy to jump on everything on a day-to-day basis, which has absolutely no relevance on the macro side, but just more on the micro day-to-day stuff. The event as such next week, even though I agree with the noise, I agree with doubt whether the data is real or not real, but the reality as a trader and as a risk taker is I have to take the data at face value, whether I believe it or not. I think the market implication is quite clear, and that's why I mentioned earlier, I think it's probably more important than the Fed, at least for the near-term direction, what people will take away from it. I agree with Günther that the tricky part would be a stronger data where the market started to lean towards, inflation is the problem, weakening job market, so the Fed continues to cut. And suddenly you get like the job market stabilizing or even start to look better, and suddenly you have a real problem out there. And that would be probably shaking the market quite a bit, especially if you look at what's happening at the long end in fixed income. On the flip side, the market is so craving direction that I think if we were to really get a very weak number, the market would just be more than happy to just run with it, start to pricing cuts, and then whatever we start to price them out in early 2026. But I think sometimes we also have to appreciate what the market really wants, because the market wants a story, and the market doesn't mind to jump on the bandwagon of a story if it means we get like at least a move that lasts a few weeks rather than just a day or two. So in that sense, I think it's very binary, very important to see. I think it definitely, of course, means that is how we're going to trade the rest of the week, but it might all, the year, but it might also be how we start the next year in at least on the FX side, on the dollar side. I think the dollar needs for the dollar to continue to go lower right now. I think it needs a very weak payroll. If you get a stronger one, I think this whole idea about the Fed pause, about no cuts, about this and that is gonna get real traction. And so I think it's, for me, it's more important than just noise. Even though I agree, I'm probably not gonna take crazy risk anymore into year end, but I think I will definitely take the data serious either way, and expect from the data that the next few weeks, maybe even 1 or 2 months, that is the direction of travel. So that's what I really feel is very, very important.
Okay, awesome. Just to finish, we're rounding up now. We're going over time, but it would be too interesting for me to want to stop this. So we've got a week and a half really of the trading year left. Markets generally die a death after the last significant bit of data, which will probably be non-farm payroll next week anyway. That's the 19th, is the end of next week. What are you doing now to manage your book? How are you actively making sure that you're de-risking, in the sense that you know any shocks that come, you're not going to be caught the wrong way? How do you deal with
that? To be honest, that's a sweet thing if you just trade FX, right? It's very liquid, it's very simple. I don't think that if you start to reduce core risk into year end, that you miss anything for start of the new year. So the only thing I do is I just drive risk down generally. I try to little bit. We forgot one central bank, by the way, Harry. Just remember, Bank of Japan. You know, so I was just about to say my main focus next week is non-farm payrolls and Bank of Japan. And I go, oh yeah, it's not on the list.
I was looking for that. I didn't see it, and that's on on me.
So I think if I may just quickly in focus and positioning terms. So for me, the end of the year is once BOJ is out of the way. I will drive down some of the risk associated with Bank of Japan and some of the other stuff that is still coming out. I have a very strong view at some point 2026 for the yen, which may not be the correct view in the very short term. But I think the most interesting story for me personally, which the market has the least clue, because most people, no disrespect to listeners, but a lot of the people are from the 2008 generation, maybe lacking a little bit of the 1990s. I think Japan is the ultimate story in every sense of the word for the next several years to come, because what's happening there is of such significance to the global market that I think that story is so big that I think the market is not seeing it yet. I know it sounds a bit stupid, but
no, it's a great cliffhanger.
I think
stay tuned for the next episode.
Yeah, no, the only thing, even though I'm a totally non-crypto guy, which I have been talking to people in the last few weeks, I think the only guys that start to understand what actually high long yields in Japan mean to the world is actually the whales in Bitcoin. We have seen a few of the whales that have been long Bitcoin for 10 years cashing in, right? So that to me is a very big sign that some people in that casino start to realize that actually something is happening that is shifting, that hasn't happened for multi-decades, and that is the cheap money is going away. And that is something that should worry policymakers across the world, right? Because at some point, good old GPIF and good old life insurance in Japan will say goodbye to foreign bonds, whether voluntarily or if the MOF suggests them to buy JGBs. That has to be seen. The yen funding trade comes to an end in that sense, not maybe from this side of the world, but maybe the outflow of yen on the other side. I think the repatriation story could be the biggest story of the next 1 or 2 years. So that's why I suggest to people, do your homework. If you know about the 90s and the late 80s, study it, because there be something out there that could actually be happening that shifts the needle on many things quite dramatically. And sorry to go on about it, but this is the biggest thing that I focus for 2026, and probably we have to look at that for probably a multi-year period, because that is probably going to be a very big shift, what may or may not come out of Japan.
You're now on record, so everyone,
yeah.
We've marked it.
I've been writing about it for. Yeah, I've been writing about this for weeks on end. I'm happy to be on the record for that. The next big topic for the next few years is the word repatriation, not funding trades. So the funding trade that greased leverage for the last few decades might come to an end. So yeah, a timestamped 1500 GMT on the 12th of December.
You heard it here. You heard it here. Well, not first, but you heard it here, guys. Just before we bring you in and close out the episode, there was a piece from Nikkei Asia. Bank of Japan set for first rate hike in 11 months. Anyone who follows this closely knows that we get these stories out of the regional domestic news agencies that they're not always right. But this one says Bank of Japan is moving to raise its policy rates December the 18th, 19th monetary policy meeting with a 25 basis point increase from 0.5% to 0.75, emerging as the leading option, according to the Nikkei has learned. That will lead to a level not seen since 1995. Apparently, Governor Ueda and his executive team have signaled they intend to submit the rate hike motion. Now, again, we've been here before with these sort of stories, and they've not really panned out. Japan are the procrastinators, the Bank of Japan, and the great procrastinators when it comes to shifting monetary policy. So much at stake, I guess. But so bear with me. Bear in mind, this story is doing the rounds, but it's not the first time we've had this story, and it's not the first time it hasn't happened. So, Gunther, just to round us off today, then your views on really how to manage your books, really, and on the Bank of Japan, if you have anything to say on the BOJ and the yen.
So I trade all asset classes, but more top down, so fixed income, currencies, and stocks. And at the moment, I like cyclical stocks. I like commodities, and that's also reflected in my currency portfolio. So the Aussie, I'm a long-term bull, for example. But then I have some hedges on in case Beat is right, and I have a lot of sympathy with that view that the yen finally rallies whenever that day comes. I mean, it's painful to watch the BOJ quibbling about 25 basis points. They should be hiking much faster, but of course they got burned the last time, and then the bubble burst, and still took 10 or 15 years to get out of this hole. So that's why they're super cautious. But yeah, the fight for capital, I agree with Beat. Maybe that's also the reason why Besant or the US has introduced these stable coins to keep demand up for treasury bills via these stable coins. And it's not a surprise for me that you see the steepening of yield curves globally. It's not just Japan, maybe that's also part of the reason, fair point. But the root cause, in my view, is fiscal deficits as far as the eye can see. And that won't change, in my view, anytime soon. So as long as that persists, and if then you have a central bank which is very cautious and behind the curve, then you see steeper yield curves. And that's reflationary. We haven't talked about China. They're also in a hole, so I guess they will also be more on the easy side. And that's reflected in gold prices, in commodity prices, copper, for example. Copper has its own story, but still. And I'm watching that very closely.
Okay, excellent. There's plenty of interesting points. Again, we've run way over time on this one, but I think it was worthwhile. But I want to wrap it up now and say thank you to my two guests, Beat Nussbaumer.
Thank you very much, Harry, for having me. Yeah, it was interesting, and I think we had so big topics to talk about. We could go on and on and on, I guess. But really enjoyed it. Thank you very much for having me.
Awesome. You can find Beat at Macro Beat, FX Macro Trader Research, and FX Tutor. You can find him on his site there. And also, thank you to Gunther. Gunther, thank you very much.
No, thank you, Harry. Also for
Gunther,
your great service. Thanks.
Oh, no, thank you. Gunther Grimm, strategist and trader in FX, fixed income, macro, and quant, and owner of GGMA, a trader platform that's launching in the very near future. So thank you to you both. And anyone who've missed the start of today's episode, you can find us on YouTube and X, some of the social media sites, but also if you go to where you find your podcasts there, whether that be Apple Music, Spotify, or Amazon Music, you'll find us there as well. So go back and have a listen. A really interesting episode today, and I'm really grateful to my two guests. Thank you, everyone. Have a great weekend. We'll see you next week, and there's still plenty of trading to go before the year's out. Have a good one. Bye-bye.
Thank you. Bye, everyone.
Bye-bye, everyone. Good luck.
And Merry Christmas. Forgot, Merry Christmas.
Merry Christmas. Yeah.